Students, in the last class I told you about the new issue market, that is the primary market, in detail, the ways in which the securities can be issued in the primary market and the limitations of the primary market. Now in today's lecture I will be talking about the steps in an IPO. Now the process of IPO is a long one and there are several steps involved in it. The first step in case of an IPO is to hire an investment bank for the process of underwriting. Now see what happens. The company cannot directly issue the securities to the public. What they have to do is they have to hire a middle person or an intermediary, which is called the underwriter. This underwriter is responsible first for studying all the financial current status of the company, its assets and liabilities, and then they will decide the financial needs. Based on the financial needs, the underwriter will tell the amount and the type of securities that have to be issued. So the underwriter plays a very important role in case of an agreement. So the company will sign an underwriting agreement with the investment bank, and this underwriting agreement will tell the amount and type of securities that have to be issued by the company. So after the company has decided on the type of the underwriter that they are choosing, the second step is to register with an SEC. SEC stands for Securities Exchange Commission. So this is a body to which you have to get registered in order to issue an IPO. Okay, so the company along with the underwriter will file the registration and they will give details about the fiscal data. So they will give details about all the financial transactions over the previous years and the plans of the company, why it is going to do an IPO, what is the use of the funds that it is going to do from the IPO. Okay, so if this registration certificate is accepted by the SEC, then company can be able to go for an IPO. However, if the company has not disclosed everything properly, then the company is not allowed to go for an IPO. Then it should work on the documentation again and come back for the registration. Okay, now after the company has registered itself with an SEC, the third step is to draft red herring document. Okay, see, the initial prospectus which is made for an IPO and it contains probable price per share and other details is called a red herring document. So this is very important. This is the initial prospectus and it contains details about the approximate price and the number of shares, okay, that is going to be issued. Okay, so it is called red herring document because the first page of the prospectus contains a warning which states that it is not a final prospectus, that is, it is an initial prospectus. So red herring document because it is giving a signal that it is just a initial prospectus. Okay, and the main aim is to test the investors, okay, whether the IPO is going to be accepted or not. So this is just a test for the investors. Okay, now the fourth step in an IPO is to go on road. What does this mean? See, the executives will travel across the country to market the IPO. So this is basically a marketing step. Unless the public is able to know that a company is going for an IPO and the other prospects of the IPO, that whether it is going to be good or not. So marketing has to be done for an IPO also. Okay, so after the initial red herring document is given to the public, the company executives, generally the underwriters, will go for marketing of the IPO to potential investors, and especially they will go to qualified institutional buyers, because they generally buy in bulk and they can greatly influence the price of the shares. Okay, so under marketing they will present the facts and figures, okay, so that there is a positive interest of the investors in order to buy the IPO. Okay, now after that you will do the pricing of the IPO. Now I told you there are two ways to price the IPO. The first is a fixed price method. Now in a fixed price IPO, a fixed price will be given in the order document itself. Okay, but what the second method is called the book building method. Now what happens in a book building method is the potential investors are asked to submit a bid. A bid is a kind of a statement which tells what is the price that they are going to pay and what is the number of shares they are willing to buy at that price. Okay, so in book building process the investors are asked about the number of shares and the price that they are going to pay for the security. Now based on this the company will determine what is the aggregate demand in the market, and based on the aggregate demand the company will give a cutoff price, that is the minimum price for the IPO, and on base of this price the share allocation will happen. Okay, so this is the process of book building. Now after the IPO has been priced, the next step is to make available to the public. Make available to public. See, so what will happen? There will be a planned date. The company will always have a planned date for the IPO. Okay, and on this date the application forms will be made available to the public both online and offline, and the investors can get this form from any bank or broker firms. Now after the public fills in the details they can submit it with a check, or they can submit it or online also. Okay, now as per the Securities Exchange Board of India, the IPO can be available to the public for 5 working days. So within 5 working days the investors have to select the IPO and give the payment to the company. If the 5 days are over, then the IPO is not allowed to be public to the people. Okay, now the last step in case of an IPO is going through the IPO. So you have made it available to the public. Now after 5 days people have come up with the investors have come up with their choice whether they will buy or not. Okay, now after the IPO price is finalized, the stockholders and underwriters will decide that how many shares are going to be allocated. So it is not necessary that investors get all the shares that they have applied for. Okay, they can get full securities, okay, or they can get less also. So it depends upon the total number of investors, and on a pro rata basis it is distributed. Okay, and these shares are credited to the demat account of the individuals. Now if suppose I have issued securities for I have issued 100 securities, but there are more number of investors who have come for the securities, means there is an oversubscription of my IPO. So in that case, these investors will be denied and their extra refund will be made for oversubscription. Okay, so after the securities are allotted, the stock market will start trading the company's IPO. Now after the first time the company's IPO has been done, if next time some investor is willing to buy or sell this security, it can happen in the secondary market and not in the primary market. So this is the entire process of an IPO. First, the company who is going for an IPO has to hire an investment bank for underwriting. After that, and this underwriter will be acting as an intermediary between the company and the final investors and will perform all the tasks of the IPO on behalf of the company. Now after that, the company has to register itself with an Securities Exchange Commission. Now for this they have to give all the important documents. If the documents are accepted by the SEC, then they get a green signal. If there is some lacking, they are sent back and then they have to revise their registrations documents and come back. Now after registration, the companies can issue a initial prospectus, which is called a red herring document, because this is not the final one, and this is mainly done to check the investors' behavior in the market. After this, there will be a marketing of the IPO in the market to make a positive impact of the IPO among the investors. Post that, the IPO price will be finalized, and after that, and this price can be finalized either based on fixed price or book building process. After that, it is made available to public for 5 days. Within 5 days, the public applies for the IPO. Now based on the number of subscriptions received, if there is less subscription, then the investors can get the full amount that they want. However, if there is oversubscription, then a refund is made to the investors. Okay, so in the next class I will be talking about the secondary market. Thank you.